Welcome to this explainer. Today we're unpacking what is honestly a wild ride in the semiconductor world. Few stories in tech right now are as packed with AI ambition, high-stakes execution, and just pure market disruption as what's happening at Arm Holdings. If you think you already know the semiconductor landscape, well, buckle up, because the ground is literally shifting beneath our feet.
Let's jump right in. 110%. The British chip designer has been on an absolute tear, more than doubling its value with a staggering 110% jump year-to-date in 2026. This isn't just a little bump. We're talking about a massive revaluation of a company that is suddenly sitting right at the very center of the AI hardware universe.
And here's where it gets kind of crazy. Despite that incredible gravity-defying momentum, the stock has also plummeted nearly 50% from its spring highs. How does a company double its value and still suffer a 50% plunge within the exact same year? What is pulling this stock in two completely opposite directions? Let's figure it out.
Section 1. Record-breaking earnings.
To really understand this turbulence, we've got to look at the financial realities driving the news cycle. The top-line revenue is just staggering. Arm pulled in $1.29 billion. That's a 22% increase year over year, and it easily blew past Wall Street's expectations of $1.26 billion. That kind of beat proves that something foundational in their business model is absolutely firing on all cylinders.
Breaking this down a bit, adjusted earnings per share hit 45 cents, beating estimates. Licensing jumped 23%, but the real star of the show here is royalty revenue at $715 million. Behind that specific metric is the real story. Data center royalties more than doubled year over year for the second consecutive quarter. That is the AI boom translating directly into cold, hard cash.
And that brings us perfectly to this quote from CEO Rene Haas, who pointed out that this record quarter reflects growing demand for the Arm compute platform as AI expands across cloud infrastructure. The absolutely crucial takeaway here is that the hyperscale cloud providers, the titans of the internet, are rapidly accelerating their deployment of Arm-based processors to handle these massive AI workloads.
Which leads us to Section 2, the AGI CPU shift.
To understand why Arm is generating this kind of cash, we have to look at their historic pivot. For decades, Arm's legacy business was basically selling intellectual property. They sold the blueprints that other companies used to build processors. It was incredibly successful. These blueprints are in 99% of smartphones today, but they never actually made the physical chips. Well, that all changed in March 2026 with their new frontier, the Arm AGI CPU. For the first time ever, Arm is producing its own physical silicon, specifically designed for agentic AI infrastructure. These are AI systems that don't just chat with you, but actively complete complex tasks for you.
We're talking up to 136 Arm Neoverse V3 cores per CPU. To put that into perspective, this delivers over twice the performance per rack compared to traditional x86 server platforms. This is a monumental technical leap for AI data center computing. They aren't just dipping their toes into the hardware market. They are aiming to immediately outperform the established giants right out of the gate.
And the market reaction? Absolutely explosive. When Arm launched this business, they initially projected a $1 billion revenue opportunity across 2027 and 2028. But in just one single quarter, actual customer demand eclipsed $2 billion. Demand quite literally doubled faster than anyone anticipated, pulling in new customers across the US and China, and they've already locked in major players like Oracle.
Section 3. The Stock Roller Coaster.
With numbers like that, you'd expect a smooth upward trajectory for the stock, right? Well, let's walk through this timeline to really feel the post-earnings whiplash. On July 29th, they announced those record-breaking numbers, and what happens? The stock actually falls 6% because investors were spooked by a slowing smartphone market and wanted more clarity on the new CPU. But wait, by August 4th, the stock jumps more than 11% as traders lean heavily back into AI optimism. The very next day, August 5th, shares surged 17.4%. That is their biggest single-day gain in over a year. By August 14th, the dust finally settles at 279.44. You can literally feel the tension and confusion in the market.
Okay, let's look at both sides of this. Section 4, the bull case.
To make sense of this wild volatility, let's start with the optimists. Bank of America analyst Vivek Arya recently put out a stunning forecast. He projects the total CPU market will hit $210 billion by 2030.
That implies a massive 36% annual growth rate over the next few years. And the bull thesis here is that Arm is positioned to gain market share faster than any other competitor in this expanding $210 billion pie.
The bulls are getting their confidence directly from the absolute biggest names in tech: NVIDIA's Vera, Google's Action, Amazon's Graviton, Microsoft's Azure Cobalt 200. These massive hyperscalers aren't just testing Arm architecture in a lab somewhere. They are deploying tens of millions of Arm cores into full-scale production right now.
All of these massive deployments build into undeniable market dominance. When you look at hyperscale cloud CPU compute among the largest internet giants, Arm's architecture now accounts for roughly 50%. They've essentially captured half of the most important computing real estate on the planet.
Because of this, the consensus on Wall Street remains a moderate buy, with an average target of $285. Jefferies even has a $320 target. The bullish conclusion is that transitioning from just licensing blueprints to selling physical silicon completely changes Arm's economics. If they pull this off, it gives them a very real path to $25 billion in annual revenue by fiscal 2031.
But we've got to flip the coin here. Section 5, the bear case.
Here is the massive elephant in the room. Arm's valuation trades at a jaw-dropping 215 times forward earnings. Compare that to the undisputed AI king, NVIDIA, which trades at just 21 times forward earnings. Arm is also trading at a nearly 49 times price-to-sales ratio. At this extreme valuation, there is absolutely zero margin for error. Any hint of disappointing growth is going to be punished severely.
This is exactly why analysts like HSBC's Frank Lee slashed their price target down to $230 with a hold rating. The bears are pointing out very specific operational risks. They argue the market is way overly optimistic about how fast the server CPU segment can actually grow. They also point to capacity constraints at TSMC, the manufacturing giant that actually builds these chips, meaning Arm might not even be able to manufacture enough chips to meet this demand. And let's not forget, their core smartphone business is currently facing heavy memory cost headwinds.
Furthermore, when you scratch just a little bit below the surface of those record earnings, a slightly different picture emerges. Yes, the adjusted earnings look great at 45 cents per share, but the GAAP reality, the generally accepted accounting principles, showed a miss. Actually, they reported 25 cents EPS against a 40-cent expectation. Why? Well, because massive spending is hurting margins, which compressed down to 7% from 11%. This includes ballooning R&D costs and a massive $312 million investment in an AI startup called Olix. So they are betting big, but they are spending an absolute fortune to do it.
So, where does this leave us? Section 6, the big picture. We've got record demand colliding head-on with astronomical valuations. Synthesizing all of this, here are the exact catalysts you need to watch over the next 12 to 24 months. Number 1, AGI CPU execution. Can they actually scale production and turn that $2 billion demand into real revenue? Number 2, data center royalty trends. Can they keep doubling that year over year? Number 3, valuation justification. Can they grow fast enough to warrant a 215x PE ratio? And finally, they are now stepping into the ring to directly compete against heavyweights like AMD and Intel.
Arm has made a truly historic decision to build its own chips, forever altering the semiconductor landscape. But the ultimate, multi-billion-dollar question that will define their future is simply this. As they transform their entire business model, can Arm actually justify this massive premium? I want you to think about that as you watch the tech space evolve over the coming months. Thank you so much for joining me for this explainer, and as always, keep learning.